I'm Max Keiser. Welcome to the Keiser Report. Boy, it feels great to be a Bitcoin millionaire. I'm loving it. 8 months ago, if you recall, on this show and on the Alex Jones show, I said that there would be a major financial catastrophe over the next 9 months, and we've got it. Bitcoin has absolutely triumphed as the dollar has crashed 90% against Bitcoin, as Bitcoin is set to take on the world and root out the banksters, as we sorely need. We sorely need it, Stacey.
Yes, Max, we're here in New York City, the skyline right behind us, the booming city, as all the cities of the world where all the too big to fail banks are based, because this is where the quantitative easing is flooding in. The Dow hit an all-time high the very same day Bitcoin, the unmanipulated free market of Bitcoin, hit an all-time high, $46. And I want to turn to this headline, Max. The target value for Bitcoin is not some $50 or $100. It is $100,000 to $1 million. Bitcoin's value is at an all-time high again. Its market cap is now twice what it was at the 2011 peak. It is nowhere near its potential, Rick Falkring says, which is 4 orders of magnitude above today's value.
Yeah, well, the Dow Jones has hit a new all-time low against Bitcoin. And the paper millionaires and the paper billionaires are really highly suspect, because they're part of a manipulated world of manipulated Fed policy, manipulated bond markets. They manipulate the price of gold and silver. But all that money printing that they've done has flowed into the only non-manipulated currency in the world, and that is Bitcoin. Bitcoin is the true inflation rate, Paul Krugman. Bitcoin is the true inflation rate, Ben Bernanke. And once again, I got to tell you, it feels great to be a Bitcoin millionaire. It's gone up almost 1,400% in the last year, and I'm loving it, because there's anonymity, there's power. You're taking a stance against the paper pushers like Jamie Dimon over at JP Morgan, and this is really the currency of the resistance.
So let's look back at the Dow Jones, because that did hit an all-time high, and I will look at Charles Biederman and his daily video podcast where he talks about this.
So that brings us to today's reality, where the U.S. economy is in a recession, and recession defined as declining after-tax income year over year net of inflation, and the U.S. stock market is percentage points from an all-time high. But U.S. company insiders know what's really going on, so it's no surprise to me that insiders at U.S. companies have bought the least amount of shares in any one month, and also that the ratio of insider selling is now 50-1. Those monthly records are the most by insider sell by, and the least amount of insider buying since we started tracking insiders in 2004.
So insiders are selling at a ratio of 50-1, he says. But on top of that,
Chairman Bernanke signaled this week that the fix is still in, and the Fed will keep buying $4 billion of existing bonds each and every trading day until they stop, when there's no sign of stopping. So far, the mass delusion is holding that newly created money is worth just as much as pre-existing cash.
Right, well, Ben Bernanke, up until now, there's been no way to take advantage of his lunacy and his money printing policies up until the creation of Bitcoin. So keep printing, Ben Bernanke, and Bitcoin will go to 100, 200, 500, 100,000, $1 million of Bitcoin. There's plenty of room for it to go to $1 million per Bitcoin.
So, as I said, the Fed is buying $85 billion in securities to help Wall Street out. At the same time that we've been here in New York, we've seen the sequester happen. So $85 billion in automatic cuts are happening for the schmucks down at the bottom. So I want to look a little bit further at this discrepancy between the $85 billion of free money given to Wall Street and the $85 billion cut in services to the poor. First, we'll look at Hong Kong, because all the financial centers are really seeing the benefit of quantitative easing. Hong Kong notches $84 million home sale. So this is a home in Hong Kong, Max, that sold for $84 million this past week. It had previously sold in 2006 for $26 million, so almost tripled in the last 6 years. All the people have the same thinking, according to Wong Long Sing, a realtor in Hong Kong. He said that the government cannot do anything about home prices. As long as there is quantitative easing around the world, people think the price in Hong Kong will always go higher. So he was talking about a new tax that Hong Kong has introduced of 15% on foreign buyers. And of course, this home was sold to a mainland Chinese investor. They don't care about that 15% tax because they think they're betting on the quantitative easing continuing.
Right, well, let's talk about Hong Kong real estate, or the real estate in London, or the real estate in New York, and the prices keep going higher and higher. The governments are becoming more and more bankrupt as Bernanke keeps floating claims that can't possibly be met. So the government will be confiscating those homes in Hong Kong. The government will be confiscating those homes in New York and the city of London. The government will not be confiscating Bitcoin. That's a huge difference between Bitcoin and having a fake illusory wealth tied up in a piece of real estate. Back in the 1930s, of course, America under Roosevelt confiscated gold. Well, they can't confiscate Bitcoin. It's immune from government stupidity, which is what's making it drive even higher. So if you have an $85 million home in Hong Kong, you should sell it and buy Bitcoin if you want to preserve your wealth. Otherwise, you're just giving the government a lot of your money.
So, well, you speak of the government intervention in the market, and now we're going to look at the other side of the people who can't afford the full price represented of the cash flowing into the market from quantitative easing. So if you're at the spigot of the Fed's quantitative easing, you of course can afford an $84 million home because you're getting the cash first before it spreads down to the peasants. Now in China, they have built all these ghost cities, but this headline in particular I want you to look at. This 60 Minutes video of China's ghost cities is more surreal than anything we've ever seen. So this is from Business Insider, and they say this is surreal. This empty city, this giant, vast city, and you can see lots of pictures here, that they're totally empty, and this is government policy. But how much more surreal is it than the same government policies of quantitative easing and buying all these mortgage-backed securities from Wall Street? How much more surreal is it that all of our reconstituted meat, the pink goo chicken McNuggets, now the poo and the IKEA almond cakes, the horse meat scandals, it's just as surreal, the same sort of effect, the hollowing out of our, the integrity of our markets, but in the integrity of the food supply.
Yeah, those ghost cities are just like Casperville. Nobody lives there because they just build under this Keynesian model that to just be active is the broken window theory. Just break all the windows and then rebuild all the windows, and break all the windows, then rebuild. That's the economy. This is what their theory is. This is what the academics say. This is what the PhDs believe. This is what the neoliberal model suggests. But it's all a bunch of nonsense. Did I mention how good it feels to be a Bitcoin millionaire?
Yes. And how do you like this rain and snow and construction?
The clouds are opening up to herald the arrival of Satoshi Cyberchrist. Christ is back, and he's got Bitcoin.
Well, let's look at the bottom, the sort of workers that used to be part of the economy here in America. So outside this bubble of New York City, where they have the largesse of Ben Bernanke's $85 billion keeping this economy afloat, where construction is booming, where the city is booming, where record house prices continue. Outside of this matrix, outside of this bubble, we see Americans see biggest monthly income drop in 20 years. Personal income decreased by $505.5 billion in January, or 3.6% compared to December, on a seasonally adjusted and annualized basis. That's the most dramatic decline since January 1993.
Yeah, this is the Zyklon B of monetary policy. Let's get rid of all the workers, let's get rid of all the savers, let's get rid of all the people, the breathers, the eaters, and just keep all the money for ourselves and trade bonds with each other and buy art at 5,000 times last price. Meanwhile, Satoshi and the Bitcoin army is taking them on, and these people's days are numbered.
Well, and the other interesting thing is that the article then goes on to kind of say, here, the bright side of things is that if you just take on more debt, you'll be fine. Because they said, all of that said, okay, you don't have a job, but consumers are benefiting from a housing recovery and rising stock prices.
No, the consumers are taking on more debt than ever. The stock market's up on record debt. Housing is up on record debt. The economy is up on record debt. the bubble in other assets aside from the dollar against Bitcoin is coming. Then next the dollar is going to crash against gold and silver. Then the dollar is going to crash against oil. So the bubble our serial bubbles are popping. Bitcoin's leading the way. It's showing what can happen when you take a fake currency like the dollar, you put it up against a real currency like Bitcoin. And now this is the beginning of the end for the Bernankes of the world who have been out there just talking nonsense. They're on the way out.
Yeah, only in this sort of Ben Bernanke Keynesian sort of freakdom do we see where they say it's better for consumers that your house prices are rising, that it's more expensive to buy a house, that it's more expensive to buy shares. Warren Buffett, the richest man in the world, the richest man in America as well, he said that he's been quoted in the past as saying, why would I want to buy shares when they're high? Why would you want to buy expensive shares? You want to buy them when they're not. And here they're trying to tell normal average consumers whose savings, by the way, has dropped to 2.4%, down from 6.4% in December.
Right, let's break this down a little bit, because what they're saying is that it's great that the house prices go up because that can be used as collateral for a loan to go out and buy stuff. The issuer of the loans that are backing the house that you're using as collateral are issued by banks whom have no collateral. JP Morgan's balance sheet of $93 trillion of derivatives versus its tangible marketable assets is negative $90 trillion. They're $90 trillion negative equity over at JP Morgan. They're the people backing the mortgages that supposedly are getting your house price higher that you should use as collateral to go out and buy stuff that you don't need from China who stole your jobs. Until the bubble pops. Then they'll say, well, we never saw it coming. The bubble happened. We don't know what's going to happen. Maybe we should pump more money. Well, of course, they're psychotic. They're lunatics. They've taken over the levers of the machine, and they're going out of control. And only Satoshi the Cyberchrist with Bitcoin is going to save us, and he's doing a fantastic job. And did I mention I love being a Bitcoin millionaire? All right, and it's great, isn't it? And did I mention it's great being a Bitcoin millionaire? Stacey, thanks so much for being on the Keiser Report.
Thank you, Max.
All right, don't go away. Much more coming your way. Stay right there. Welcome back to the Keiser Report. I'm Max Keiser. Time now to turn to Charles Hugh Smith of 2minds.com. Charles Hugh Smith, welcome back to the Keiser Report.
Thank you, Max.
All right, Charles Hugh Smith. Global stock market capitalization rose from 11 trillion in 1990 to 65 trillion in 2007, while global assets also rose from 51 trillion to nearly 200 trillion at the same time. What does this data tell us about the global economy?
Max, I think what it's telling us is the central banks and their cohorts in the central states have created credit as a substitute for wealth. So we see these gigantic asset bubbles around the world that aren't really translating into greater prosperity to the same degree. You know, like GDP goes up a few percent, and then these asset bubbles are quadrupling.
Right. Well, in the case of a few technology executives, they're making billions of dollars. In the case of Warren Buffett, he's making billions of dollars. The Fortune 400 list that's quoted every day on CNBC, the billionaires who are making billions, they're doing great.
Yeah, no, absolutely. This whole thing of blowing asset bubbles is terrific for those people who own the assets, which, as we know, are most of the top 1/10 of 1%. But the top 10% of sort of technocrats, they're doing pretty well too, because they own a little piece of that asset bubble. So that's why you don't hear too many complaints from the elites in the state fiefdoms and academia and, you know, the whole conventional economics bureaucracy.
You talk about asset bubbles, but we've had a whole generation now that has no expectation of really being a meaningful part of this economy. So they wouldn't call it a bubble necessarily. They would just call it the new normal. They don't seem to be fighting this at all. They simply accept the fact that they've been cut out of the equation, and there's no pushback against it. So why wouldn't this just continue as it is? Because this generation has pretty much shot themselves in the head.
I think the way I look at it is what we're seeing is the complete failure of conventional economics, like creating credit in the banks, and then we're supposed to borrow and become a debt serfs and buy a lot of junk we don't want or don't really need. We may want it because we've seen too many ads. But I think it's the complete failure of conventional economics, and we have a failure of imagination. Like, people are looking around, they'd like another model, but there doesn't seem to be any model, because both socialism and capitalism have pursued this debt as the solution to all of our troubles, and so they're both failing.
Right, so it's a matter of being involved in debtism has replaced both socialism and capitalism. We now live in an age of debtism, which is an extension of the Middle Ages or Dark Ages, and replete with in keeping with the science of the Dark Ages. We have the shadow banking system, which you also point to in some of your charts as growing pretty strongly. Tell us about it.
Yeah, I think you mentioned the Dark Ages, and I think it's true. We are in a neo-feudal global economy where the vast majority of people are toiling away as debt serfs to the central banks and their cronies. And the shadow banking system is part of this system that has exploded in terms of size, that it now rivals entire nations' GDPs. And it's all happening sort of under the surface. It's poorly regulated, and in places like China, nobody really even knows how big the shadow banking system is.
Right, and you mentioned that you believe that in this neo-feudal, neo-colonial era of financialization and debtism, we have a great unwinding yet to take place. But I guess the two options would be either some kind of grassroots revolution, like we saw during the French Revolution, perhaps, or going back even further, we had the Black Plague in Europe, which wiped out half the population and finally gave some purchasing power to the survivors. So either we have a plague or a revolution. Which do you think is more probable?
I'd like to see a plague wipe out the financialization. If it could only wipe out all the phantom assets and the phantom money, then at least we could start from a base where we knew what we actually had, and then we could look at distributing the resources of the world a little more evenly, rather than increasing the inequality in the world with financialization. That would be one place to start. Just lower the cost of living, make wiser choices with the resources and assets we do have, instead of malinvestment and increasing inequality.
Yeah, I'd like to see a plague hit the bankers as well, but we don't have that. Instead, we have Jamie Dimon making comments recently. He basically unzipped his fly and waved his weenie in front of the crowd and said, "Mine's bigger than yours." And the crowd applauded wildly. And even though we have the tools to decimate J.P. Morgan by buying silver, they're remarkably short silver. We could completely obliterate that terrorist, but people they love Jamie. They love his weenie waving routine. They love his everything that Jamie represents. So I don't think the tools of the plague are there to wipe out the terrorist banksters, but the people seem to enjoy the golden shower more. Now, into this mix comes Obamacare, a major gift to the mega insurance corporations. How does this fit into this financialization endgame scenario?
I think that Obamacare is like the perfection of crony capitalism that's been sold as being something wonderful for the people. And by the perfection of crony capitalism, I mean that insanely expensive care provided by cartels that have totally opaque pricing, and that are in cahoots basically with the central state that supposedly regulates them. They're charging $70,000 for a few tests, and basically the debt serfs and taxpayers are having to pay these cartels these insane fees that are like literally 10 to 100 times beyond what they cost in another nation without crony capitalist cartels.
Why are liberals like Arianna Huffington so brain dead on this issue?
I think they're fixated on some sort of national health care system, like say, for instance, Canada's or France's, and they think that Obamacare is actually some version of that. And they have been hoodwinked by the mainstream media and all those people profiting from Obamacare. You know, talk about the bankers. I mean, how much do these hospital chain and insurers CEOs make? Don't they make like, I guess it's only 50 million a year instead of 500 million. So I guess we should feel fortunate.
Right. Time magazine just ran a cover story detailing over 30 pages of hospital executives and healthcare professionals repeatedly financially raping to near death the average healthcare consumer in America. But again, the average American seems to enjoy that sort of thing. What about what could possibly go wrong, Charles Hugh Smith, with the so-called housing recovery underway here in 2013?
I think housing is symptomatic, sort of like Obamacare, that it's like the powers that be, you know, the central state and the central bank, they have decided to reflate housing to try to get the debt serfs to feel wealthier so they can take on more debt and buy more junk they don't need. And so they've just literally pulled out all the stops. I mean, the Fed's printed trillions, it's bought trillions of dollars of mortgages, it's lowered interest rates to basically less than inflation to try to get people to buy a house and become indebted for the rest of their lives to the banks. And so they're sort of pushing on a string, though, that there's just not enough people with enough income in the younger generations to buy all these houses. And so what makes sense for a young person is to share a house or enter a co-op housing or buy a house with 5 other people. This is what makes sense, and lower the cost of their housing from 100% of debt serfdom to, like, you know, a 20%. And so this, of course, would pop the whole financialization bubble, because once people stop buying houses for these insane prices and indebting themselves for the rest of their lives, then the bubble will collapse, and they won't feel richer from phantom assets. They'll feel wealthier because they actually have their own cash.
Charles Hugh Smith, I know you've done a lot of work looking at the Japanese economy. You've spent some time living in Japan. Certainly a lot going on there. Now they've basically fired the central banker and brought in a guy who is going to answer to the president with a mandate to print money. What is going on there?
I see it as this global competition is heating up. You know, back when the housing bubble was expanding globally and China was booming in the 2000s, there was enough sort of the global pie was increasing at such a rate that every nation could get a nice chunk of the market and profits. And that's why you see corporate profits were soaring everywhere: Japan, the U.S., China, you know, Europe, you name it. And so now the global pie is contracting because this whole idea of substituting debt for wealth is failing. And so Japan is now at the end game of that. They're trying to recapture their global market by depreciating the yen. And of course, this is triggering great unease because everyone else is going, well, wait a minute, you know, the pie is shrinking. We gotta do something to save our share of the market. So they're going to try to depreciate their currency. But as we know, everybody can't depreciate their currencies together. Somebody has to be left holding the bag with a stronger currency, and that may be the United States, because nothing's better than taking stuff like oil from other people and then handing them like fake money, you know, paper money in exchange, and then that's a terrific trade. So the U.S. dollar will probably rise as everybody else tries to beggar their neighbor, but that's obviously a self-destructive process.
Charles Hugh Smith, let's jump over to the United Kingdom for a moment. They're talking about going to negative interest rates, which would mean that the banks are now going to charge customers a percentage to hold their cash. So instead of getting 0% interest on the money you have at the bank, you're going to get a negative rate of money you have at the bank. This will be from the central bank to the commercial banks initially, but then the commercial banks will probably extend this offer to their customers and say, you have to pay us an annual fee to keep your money at the bank. So savers now are dealing not only with the 0% interest rates, but they're being taxed effectively 1 or 2% every year just for the privilege of giving their money to the banks. How is this going to work?
Max, isn't it incredible? I think the banks have learned from the Fed and the other central banks who have been playing the same scam, that if you buy a treasury bond from, in the US, you get like 0.1% interest, a short-term treasury. And of course, inflation is 2.5% officially. So you're basically paying the treasury, 2.4% for the privilege of owning this treasury bill. And so maybe the banks are simply copying the central banks because, hey, if people are willing to pay 2.5% for a sovereign bond, why not 2.5% for a savings account? And it's just the same sort of skim that is the basis of financialization. Everything is a constant skim where huge sums of money are being concentrated into at the top of the pyramid.
Right. You could call it a skim, or you could just call it rent-seeking, which there's supposed to be laws against that kind of thing. Anyway, Charles Hugh Smith, we're out of time. Thanks for being on the Keiser Report.
Thank you so much, Max.
All right, and that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacey Herbert. I want to thank my guest, Charles Hugh Smith of twominds.com. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, Max Keiser saying, bye, y'all.